All right, everybody. It is getting far into the first day, and it has been a huge success so far. I'm looking forward to bringing on this very next panel to talk about insurance. Insurance is something that has, or the lack of insurance is something that has plagued this industry as a new industry, highly volatile asset that's backed by it. We have had a difficult time developing insurance products here and de-risking Bitcoin mining. But this next panel is going to come up and talk about the products that are available and talk about the future of insurance products that will be available for Bitcoiners and Bitcoin miners. So I'm going to have Taras Kuliak come on up and introduce this panel.
Hey guys, it's getting late in the afternoon, so let's put everybody to sleep with a great, exciting topic of insurance. We've got some great industry leaders here. And in all seriousness, insurance is a vital component of any operation that wants to scale up and be professional. So up first, we've got Mike Groff from RepairBit. From there, we've got Tom Shuchuk from Evertas. And after that, Patrick Datz from IMA Financial. So this will be an open format conversation. We'll kick it off with some pretty high-level discussion, specifically around the state of D&O insurance for miners and other companies. Tom, what do you think of the state of D&O insurance is right now and how it's impacting digital mining?
No comment. No, it's D&O insurance is really interesting right now. We're actually just getting into the space, and anything to do with crypto or digital assets is seen as really a adverse risk class to the market as a whole in the industry. I would say the biggest risk concerns really that are different in directors and officers insurance for crypto companies versus your traditional industries is really the vector of risk from a theft of a digital asset. So if you're not custodying the assets properly, there's a loss or a theft, someone loses the private keys. Obviously, the directors and officers have a corporate liability, a fiduciary duty, but they also have a personal liability associated with that. So if you don't have a directors and officers insurance policy that encompasses the theft or loss of a digital asset, frankly, if you're in the crypto space, that's probably your biggest exposure, quite frankly. But from a risk standpoint, it's pretty, I wouldn't say easy, but once you understand the issues, you can hone in on those and craft a solution that makes sense. I don't know that the rest of the market has really caught up to understanding those dynamics. And so most companies, from what we've seen, I can't speak to all of them, obviously, but most companies from Lloyd's and, the broader E&S market, they'll tend to exclude those types of exclusions. But Patrick probably knows more about that in the open market than I do.
Yeah, I mean, I would say it's come a long way in the last 2 to 3 years. I think in general, the DNO market, whether you're a privately held or publicly traded company in the Bitcoin mining space, in the crypto space, or you're a widget manufacturer, it's been very difficult with the large amount of IPOs and just the COVID time that we lived in. But the market is softening. So I do think we are entering a much better space when you are looking to purchase it. And ultimately, if you want to have high-level people on your boards, whether you're, again, publicly traded or privately held, it is a very important coverage. And I think we'll kind of see a common theme throughout this panel is it's all about education and just educating the insurance carriers and the underwriters who aren't familiar with the space about what it entails and how it is a very sound and safe space. And there are a lot of good protocols within it, which ultimately lead to much broader coverage and better premiums.
Mike, any comments?
No comment.
So from a premium perspective, where have they been going? Have the reinsurance and insurance companies gone smarter as to how to value their risk, given the experience and now history tracking the sector?
Yeah, I mean, I think it has gotten much better, specifically in the last 12 months. I mean, we're starting to see 30, 40, 50% decreases on some of the D&O renewals.
That's great.
Yeah, no, it's very positive. And I think the other thing, too, is the retention aspect of it, where you would have companies paying $4 or $5 million with a $7.5 million retention, which is essentially a deductible. And so now that that's starting to come down, it's becoming much more affordable because if you are a publicly traded company, it is an extremely important coverage to have, because a lot of times in the Bitcoin space, it's not a matter of if, but when there's going to be a suit brought against you. And that can be securities, class action lawsuit, things that we've seen from companies that are in attendance here today.
Fair enough. Tom, any comments on that one? Or?
No, I agree with most of that. broadly speaking, what we've seen, and this was kind of why we've lagged a little bit entering the DNO market, is because we weren't exactly sure where the price was going. So if you're going to enter a market, number one, you do have to be mindful of kind of the actuarial tables that you're putting together, as well as the rates that you're putting together and how you're thinking of risk, and then how you can quantify that. And if everybody else in the market's beating each other up and it's just a race to the bottom in terms of price, well, then you need to be mindful of that as you're going to launch a new product. So we've delayed that to 1/1/2024. We're only going to dive into the private space first, mainly because there's more regulatory concerns on the public side. Specifically in the U.S. Outside the U.S., we'll probably consider a little more risk because there is more clarity there from a regulatory perspective. But no, I think Patrick's spot on with his analysis.
So if I'm a digital asset miner and I'm looking at setting up a policy, what are the things I need to be thinking about when I'm approaching an insurance company to get my coverage in place? What are the things I need to be thinking about when I'm setting up the facilities themselves around infrastructure, et cetera? What are the top of mind ideas that operators have to think about?
I'll start. So when we look at a risk, it really depends on, the biggest thing for us is aggregation of risk. So if you have, one building that's say 30,000 square feet and you're packing in, let's say 10,000 M60s in there, obviously in terms of values, that's a very big concentration of risk. I mean, you could have, north of $100 million in one building. That's a tough pill to swallow for any insurance company. I don't care how big they are. So really the name of the game is diversification and spacing. So we can certainly consider the larger scale buildings that have the concentrations of risk. However, because the probable maximum loss in any one scenario for that situation will likely be much higher unless you have a containerized solution, unless you have smaller buildings, or I would say non-combustible buildings that you're basically building just for mining and smaller scales, but then you're going to scale it out in a larger footprint. Those are more diversified than say just one building or 3 buildings or 7 buildings at one site. And so, if a tornado drops out of the sky, it doesn't discriminate against what building it hits. It's going to hit one at least. And so if all of it's in one building, that's a very big pill to swallow for any insurance company. So the premiums and the costs follow all that risk in terms of profiles. That's probably the biggest hurdle that we see in terms of understanding that. The second one is really clients understanding the value of their computers, because as we know, the insurance policies out there today, they all pay in dollars. Well, the actual rigs themselves, they're typically priced in, 3-year future cash flows denominated, based on Bitcoin, as well as, secured by energy contracts. And then you also have, the halving, then you have mining difficulty that factors in there, and then you have supply and demand for how many miners are out there. When the M60s and the S21 start hitting the market, what's going to happen to the older generation models? Again, you're going to have a bigger supply there. So what happens to the values of those? They're not as efficient. All these things affect the values of these computers. And so you really need to be mindful as to managing your own risk and understanding, all right, if I were to have a claim, you typically don't want to insure the assets or the computers at the cost you bought them for back in 2022 or 2021. You want to think about what they're really worth today, because in that scenario, that's when the loss is going to be evaluated, and that's the value that's going to be paid. So it's a moving target, and the policy should really move with you. So every month, every 2 months, every 3 months, every quarter, you want to probably be mindful about what is the value of my assets today. And that's independent of, say, if you've got debt or if you're valuing them in terms of depreciation. It's outside of the accounting spectrum. It's really just the private contract between you and the insurance company. Now, generally speaking, sometimes it's harder for underwriters to understand why these values fluctuate so frequently, which is something we understand and we're comfortable with. But we don't have a problem saying someone needs $100 million of coverage, yesterday, and then post-halving they only need $50 million, and they come to us and they say, hey, can we lower the limits of coverage? Of course. What's your new valuation? They give it to us. We quantify that. We have partnerships on the back end that help us do that. And we're usually very comfortable doing that, because we also know that it's kind of like a bell curve. When you're in the bull market again, when you're at 50 million, you're going to see in the next 6 months, well, hey, now my assets are worth 200. Okay, well, it's not really about premium to us. It's about identifying the risk and properly insuring it. And that's one thing that we really try to harp on with clients when we speak with them, to make sure that they fully understand what it is that they're buying and how to properly value those. Because when you do properly value those, costs tend to follow. And even if you want to undervalue them, you're comfortable just taking 50% of the insurance limit on whatever your values are, that's fine too. we can do that. But you need to be mindful of the limitations of the contract you're buying. And frankly, every contract's a little different for every company, and every underwriter is different. But we're very cognizant of those changes.
So it sounds like continuous mark-to-market of hash rate itself is what you guys are doing.
Yeah, that would be accurate at the client's behest.
Right. As they want to revalue their policy to make sure they have proper coverage given the market realities at the time.
Yeah, that's correct. Which is also probably why you should work with an agent or a broker, because we're not direct to clients. We work with people like Patrick to distribute our products. And so you need to work with an agent or broker that I think is very familiar with the space, that understands, hey, I just saw Bitcoin go to 50,000. Probably should check in with my client to make sure that their assets are properly insured, because we know that the value's just probably increased. So, Patrick understands that. There's others like him, and so that's why we were working with those particular agents. But much like not every underwriter is created equal, brokers and agents aren't created equal either. So
Amen.
there's a learning curve.
Amen to that. Mike, you're going to say something?
Yeah, I was going to say something else that's important to consider is what type of maintenance program are they implementing? Are they being reactive, saying, okay, I have minor corrosion or minor damage, or is the client being proactive and saying, I'm doing a preventative maintenance program using anti-corrosion, etc.? Because then it shows you the client's being proactive with their mining fleet. Well, what that does for the insurer is lowers their risk, rather than a client who's being reactive, and then the result of that would be lower premiums.
Patrick, what's your take on that?
Yeah, I think between those two answers, y'all nailed it. And I think one thing that, Tom brought up that I think makes a lot of sense is, working with someone through the process that understands what you're doing, understands your mining operation, because, what our job as a broker is to essentially sell the risk to the different carriers. So it's like when we have a risk, we take it to Tom and his team and say, hey, here's the risk, here's what they're doing, here are the loss mitigation protocols I have in place, whether that be, biometric locks, 24/7 video monitoring, temperature monitoring. Those are all things that, make it a lot easier for us to sell the risk to Tom and his team and other carriers, which again, return are going to end up in, a much better program for your company, from a policy standpoint, premium standpoint, all of that. And I think one thing that, as a consumer can be frustrating is the process can be very tedious. We're going to ask a lot of questions. The carrier is going to ask a lot of questions, and it can be frustrating, but I think the end result is going to be a much better product, because essentially if something does go wrong, you want the carrier to fully understand, what the risk looks like, so you can get paid out during a claim.
Here's a question. How do you actually do the mark-to-market on rig valuation? Is there a specific data set you use? Is it in the market? Do you have a team you've dedicated to this? How do you actually go out and scrape current values?
So Patrick probably is working on behalf of the client, so he's going to follow their lead with what they think. And I don't think it's a straightforward answer. I think it's a moving target, because
Perfect.
Everyone has their own economics, right? Someone that mines at, say, 9 cents a kilowatt hour isn't profitable in this market. Someone that mines at 2 cents a kilowatt hour is profitable. Therefore, an S9 for someone that mines at 9 cents, it's not worth anything because they're not using it. It's a liability on their balance sheet. If you're mining at 2, you can still mine profitably at an S9, but what's it worth? It depends on what's it worth to you, the client. And so it's not a straight line depreciation model. There's not one answer that's correct. And then furthermore, let's say there was a claim. Let's say, a public miner that has, direct contracts or buys at scale with the manufacturers. Their cost of the new machines, should they need to replace them, is going to be lower than someone that doesn't have that economy of scale. So that's not to say that an S19J Pro 100 terahash, which is roughly worth spot today around $500-$600 maybe, maybe a little more.
That depends.
Yeah, it
Depends on quality, condition.
It does. It depends. So the point is that not every buyer is the same in terms of what they value the asset at and what they can purchase it at, and we understand that. So it's not as if we approach every situation with just one solution. We approach it with a methodology in hand and say, look, we see the statement of values, we see the list of everything that you have. We just have a couple questions around how you arrived at the values, and depending on the answers, we can back into understanding that, and we're fine with it. And again, whatever the client wants to do, we'll typically do it. We're not going to be out here over-insuring things, or we're not going to be out here just, undercutting everything. But it's if it makes sense and you have a methodology behind it, that's fine. And then, furthermore, it's really a dynamic marketplace. We don't even know what's going to happen when the new machines are going to be delivered. We don't know what's going to happen at halving. I mean, how are the new machines going to be valued post-halving? You know, they're still more efficient than everything else. So are they going to depreciate by roughly 50%, 40%? We don't know. So it truly is dynamic, and you're constantly evolving and learning every single day because we don't know.
And how about the reinsurance companies? How are they viewing the space now? Are they getting more comfortable providing more coverage limits? I know about 2-3 years ago when I was with what's now a public company, we were going through Aon for our insurance needs, and they capped us pretty low for what we thought we needed for commercial liability insurance. Where are the reinsurance companies at now?
Well, so that would depend on what you're insuring. So if you're just going to talk about the property aspect, the actual mining rigs, I would say that market from a reinsurance perspective, and just for those of you who don't know, reinsurance is really insurance for insurance companies, essentially. So insurance companies don't hold all of the risk on their balance sheet. They typically take 25 to 35% of it, and then they purchase reinsurance on the back end to diversify their risk, right? So they're not the ones holding the bag in any one loss scenario. So the reinsurance companies, they, especially what's happened with the last couple of years with all the catastrophic events, Ida, the Hawaiian fire. I mean, because everyone's so diversified, that means the reinsurance companies, everyone's exposed to everything, which means that anytime there's a natural disaster, a tornado, a hurricane, what I think of is I go, oh, wow, how is this going to ripple through the effects of my market and how we're able to procure reinsurance? And what does that mean for our capacity capabilities going into next year? Right now, we can do 200 million. What are we going to be able to do next year? On the mining side, we'll be able to do more than 200 million. Just full disclosure, I've been working on that really hard. But the reason I've had to work on it really hard is because every insurance company, every reinsurance company in the world, for the most part, doesn't understand the dynamics of this industry. And therefore, because they're not familiar with it, they don't understand it, and they don't have the knowledge base, they refuse to try and quantify it because they're really just throwing a dart at a dartboard. So they rely on people like me and our team at Evertas to really quantify the risk for them, and they're much more comfortable reinsuring people like us versus somebody else that wants to be more transactional and say, oh, I can get, 40 cents on the dollar for charging, premium on this risk. I don't really know what a good risk versus a bad risk is, but, I know I can make a lot of premium doing it. So why don't you back me? So it's a really tough conversation, especially when all the reinsurance companies are really trying to tighten the belt and stop the bleeding on their other vanilla books of business that they've been in globally for many years, where they have hundreds of years worth of data on. And in this scenario, in this industry, you just don't have that data. So they're very reticent to even put forth a foot, let alone a toe, to dip it into the pond and say, yeah, we'll try this out.
Well, we continue to evolve and mature as a sector, that's for sure. Mike, any misconceptions you think are out there around insurance and repairs and warranty within digital mining?
Yeah, absolutely. I think around insurance, when I think of insurance and my mining outfit, I think about, okay, what if a fire occurs? What if a tornado occurs? Will I be covered? Will I not be covered? Right? Traditionally, if you have a loss event and any other things, like let's say I get in a car accident, I don't really know what's covered until I actually have that catastrophic event. So I think what Evertas has done a fantastic job of, and their partners in the space, is being transparent of, if there is a loss event, I know with certainty I'm covered in scenario X, Y, and Z. And then maybe there's another scenario I'm not covered in, but I'm comfortable with that risk. And then what's important to me is the quality of the reinsurance partner. Is it a good insurance partner? What is their paper rated? If I do have a loss, am I going to get paid out quickly, right? Or are they going to drag me through the mud on that? Because what I care about is, if I have a loss event, how quickly am I going to be up and running? What dollars am I going to get for the salvage of the units? Or how long is it going to take me to repair? And all that is dependent on the quality of the insurance partner that I'm with.
Interesting. Patrick, how about you? What misconceptions would you tell the audience that exist right now?
Yeah, I mean, I think no one really likes insurance until you need it. I mean, I think that's the epitome of what it is. But when you need it,
players, right?
Yeah. But when you need it, you want it to work. And so, I think, Mike nailed it. I mean, you want to understand of what you have, and so, you don't want to be in a situation where you have some kind of catastrophic event, and you call your broker, you call your carrier, and they say, well, wait a second, that wasn't claimed, and you've been paying premiums for however long, and you feel like you're getting the short end of the stick. And so I think that's why just working with a broker who understands the space, and then that broker works with a carrier who understands the space, is going to be really important at the end of the day.
Fair enough. Mike or Tom? Sorry.
I don't really have much to add to that. I think we've touched on everything. I would just say that from really what it comes down to is making sure that you've got a good partner that's guiding you through the process. You want a good broker that understands the contract. And, we understand that, we started off the insurance, we're backed by crypto companies. We're not backed by the insurance industry. I was involved in mining in 2020 and 2021, 2022. Our board and everybody else has been in crypto for a really long time. So we serve the crypto industry. We don't have another industry to run to. I can't, if crypto fails, I can't go write hotels tomorrow, right?
Yep.
It's not how that works. So we're very much invested and focused on this space because we believe that long term, if you don't have insurance products that can scale and are scalable solutions for the industry, you're likely not going to get more capital investment because people can't de-risk that capital investment. And I think what's really unique of what's going to happen in 2024 with probably the advent of the ETFs, more institutional capital coming in the space, I think we'll probably see more meaningful regulation, likely post the 2024 election. I don't think we'll see anything before that, and especially here in the U.S. But once these bigger institutions get involved, then they start lobbying Washington. I think that's when we're going to have regulation. But they're not going to get involved in a big way unless they can de-risk themselves with, companies like us. So it's a moving target. We're learning something new every single day. We have no idea really the vectors of risk that are present today are going to be present in 6 months. So you have to be constantly vigilant. And then you also have to keep pushing the envelope forward. So one of the things we're doing is we're developing a fire suppression system for mining that would be retrofitted to containers and different buildings. And so our goal there is basically to roll out that option. We'll have a pilot program with some of our clients that have been interested. And the effect would be, okay, if it costs you, let's say, $50,000 to install the fire suppression system. Well, if you install it, number one, our goal is to give you, a $50,000 credit year one, or maybe a $35,000 credit year one. That way you can recoup the investment on that in 1 to 1.5 years. And if you can do that and you've installed all the fire suppression systems, well, guess what? That credit stays on your risk in perpetuity for as long as you have it. And we've designed it so it lasts about 10 years. So yeah, longevity was key for us. So, for us, it becomes a superior risk. Why? Because there's automatic fire suppression. But then that should also encourage, more competition against us from the industry to say, oh, wow, these operations may be in the middle of a solar farm or a flare gas site in West Texas, yet they do have an automatic suppression system. This is something that we can actually consider because we respect that, and now it's a superior risk in our eyes as well. So we're constantly trying to drive the industry forward and try to get more participants, but you can't do it unless you do it, right? So it's a moving target. So we're constantly trying to evolve, but again, you need to have partners in that space, I think, that help you along that journey, because what we're doing today is not likely going to be the same what we're doing in 8 months.
Hey man, this space changes like in dog years. I mean, 1 year in digital mining is basically 7 years on your life. We've all got a bunch of gray hairs from this space already. Speaking of competition, BitSure to Evertas, M&A, consolidation. Do you think that's going to happen in this space?
Possibly. I think we don't really think of ourselves as competitors to people in the space. I think that we understand that we can't be everything to everyone, and we don't want to be. There's different flavors for different folks, and there's different insurance companies out there that think of the risk differently than we do. Do we believe that we are probably the most experienced in this risk? Yes, of course. But there's others out there that may have a different viewpoint and disagree, and that's fine. Namely, I think one of the bigger insurance companies that's been around for a really long time is Realm. They're fine. They do, this space fairly frequently, but, I think a healthy ecosystem is when you have multiple competitors in it, because that's really validation of what you're doing. And I don't think we're being led astray there by pursuing this industry as much as we are. But from an M&A standpoint, BitSure and Evertas just made sense. I mean, we had a lot of synergies, and we started working together on an underwriting consortium basis, and it was very apparent within 2 months that we were a good fit for each other. So that's why we did the merger. But I don't know that consolidation is going to continue, just because I don't know that the knowledge base out there is really respected yet from the traditional insurance companies, where they would say, hey, we'll go out and acquire someone that actually has an expertise here. I think what the industry is waiting for is to say, okay, we'll wait like 3-4 years. Evertas can do $200 million a site. Realm can do $10 million a site. let's wait and see in terms of the frequency of claims and the longevity of the policies that they're writing. What does that look like over a 3 to 5 year period? They need a larger sample size before they can say, okay, they're a good outfit, or maybe we want to get in the space ourselves.
And Patrick, on the brokerage side, do you have the same opinion?
Yeah, I mean, I think from our chair, we want competition. I mean, we want competition for Evertas because essentially that's going to be beneficial for our clients in the space to have various options to choose from, and it's going to keep driving the carriers to try and innovate. And I think kind of that next big step is having the traditional insurance carriers that you see advertised on TV, the Chubb, Liberty Mutual, Hartford, CNA, for them to start to dip their toe in the water to create more competition in the marketplace, which I think will, again, lead to innovation. And I think, like Tom mentioned, with the regulation coming in and more of these financial institutions starting to write white papers on the space, I think that's going to start to catch the eye of these traditional insurance carriers, and that's, again, going to create competition, which is a good thing for everyone.
Yeah, agreed. And Mike, on the repair side, I mean, RepairBid and HM Tech, I think, are the top 2 repair centers in North America at this time. Do you think consolidation of repairs within the smaller players, because there's tons of like 2 to 5 technician shops, do you think that's going to happen?
Yeah, absolutely. I mean, we're seeing it across the industry, whether you're in mining or repair or building data centers, and it's going to happen into the repair world. I know we're looking at doing a lot of exciting things over at RepairBit on a lot of different fronts, especially the preventative maintenance. But what really gives me excitement about the insurance world is as these products mature, what that unlocks is more institutional capital and leverage to come into the space. So I think if anyone wants to have success going into 24 and 25, if you're not looking at rolling up and doing M&A work before all this institutional money comes in, you're already behind the 8 ball.
Amen. Building the bear market, which hopefully we're exiting at this point. Well, I really appreciate your time, gentlemen. This has been a great panel. Hopefully the audience enjoyed this, and thank you for your time.
Thanks, Strauss.
Thank you.
Thank you.
Hey guys, thanks for coming out to the 2023 North American Blockchain Summit. It was the best summit yet. We look forward to hosting you again next year. If you enjoyed the summit or like what you saw in this video, be sure to subscribe. If you're interested in learning more about membership in the TBC, go to texasblockchaincouncil.org to learn more.